Turn to the market reaction today following the print. Joining us this morning is Ed Yardeni, of course, Yardeni Research president. Ed, great to have you again. Good to see you.
Thank you.
I think it was Heather Long at the Washington Post this morning who said it's looking more and more like the U.S. inflation battle is done. Are you willing to go that far?
Absolutely. I've been predicting since the summer of 2022 that we get to 2 to 3% by the end of last year and early this year. And we're basically there, and we think that we'll get to 2% by the end of the year. If you take out shelter from the CPI, you're basically there. When the kids in the back seat ask, "Are we there yet?" We're there. If you take out shelter, we're at 1.9%.
So we're entering the parking lot, I guess. Are you suggesting that? Then I think shelter is what, 90% of the increase this month?
I believe so. Yeah.
Yeah. Do you expect the follow-on effect to accelerate, or is this going to be a continued test of patience with that lag?
I think it's clear. We all know it's a lagging one, but it could pick up. I mean, it's really just kind of a laggard that's catching up with current rents, because it includes not only current rents but also outstanding rents. But I think time is actually on our side in terms of getting faster decreases in rent.
The other note of yours, Ed, that got my attention this week was yesterday when you talked about what's happening in Kursk with Ukraine and the notion that if Putin is really pressed, his reaction might be, I think the word you used was unsettling. How high is that ranking on your radar?
Well, it's really number one. The geopolitical concerns have been my main concern. I haven't been concerned at all about the economy, and I still think it's resilient. By the way, I think that the next employment number is going to be a strong one, because I think the last one was weather affected. Inflation's not concerned because it's going the way we thought it would go. So at this point, between what's going on between Russia and Ukraine and the tensions and conflicts in the Middle East, there's a lot of geopolitical risk. The price of oil on Monday was up like 3% on all this war talk about the Iranians about to attack Israel. And then yesterday, I think a lot of yesterday's rally was because the Iranians said, if the Israelis and and Hamas work out a ceasefire, then they won't attack Israel. So it's on and off here in terms of the geopolitics impact on the market.
I do wonder, Ed, though, if we're in a place, and I talked about some of the more aggressive pricing for Fed cuts, where this benign inflation data isn't as soothing to the market as it once would be, because the market is expecting more cuts, and you would really have to just see a deterioration in the economy to justify those cuts, which is not ultimately good for equities.
Yeah, I've been opposed to a rate cut, but I'm a reasonable person. And, if the Fed signals that they're going to cut no matter what I think, then that's what's going to happen. But I think it's a quarter point, and I think it's one and done for the year. I don't buy this 50, 100 basis point cuts in the Fed funds rate.
Yeah, odds of an intermediate cut obviously plummeting here, even after the panic of last week.
That would have been a disaster. That would have been a disaster, because it would have worsened the carry trade unwind.
Yeah, you pointed that out in the midst of all the action last week. It would have been ironic and bad. Ed, thanks, as always, Ed Yardeni. Sure.